just to actually give everyone a little bit of context around the start of the investment series and what we are actually doing at Venture Taranaki is we have just launched the Power Up initiative. So the Power Up initiative is to help support enterprises along their journey to grow. You can get in touch with myself or Sian from Venture Taranaki to talk about some of them opportunities more and how we can support you. So that would be a great point of call and always there to help. For now, we'll pass over to Ian, who will briefly do sort of a catch-up session on the first session, very briefly, and then we'll kick into all of the things that we need to know for part 2. Thank you, Ian.
Thanks, Stephanie. Kia ora tātou. Welcome to everyone. Now this is the second, as Stephanie has said, of the 2 lunchtime sessions on what investors are looking for. And I see some familiar faces from last week. Is it just a show of hands, please, those that weren't here last week? Okay, good, that's all right. I will just summarise briefly what we covered last week, but very briefly. If you've got further questions, you can catch up with me after. And thanks, Stephanie, for explaining Venture Taranaki's role in all this. Just a little bit of background from my perspective. I had been to high school here in Taranaki, and I went and worked all around the place. And I spent the last 20 years of my working career in Wellington. About 5 years ago, my wife and I decided to relocate to we're out at Aokra, but we decided to relocate to Taranaki, which was great, fantastic. And at the time we arrived, they were just setting up an angel group here. So I'd been running an investment company in Wellington, so John Haylock got onto me and I ended up chairing the angel group here. But the angel investment group is really only part of the jigsaw. And I was delighted when Justine Gillinan was appointed as the new Chief Executive of Venture Taranaki probably 18 months ago. And I mean, that was great because it brought a fresh perspective to it all. And it was right at the right time where Taranaki was, the joint councils here were actually setting up a strategic plan for the whole of Taranaki. And as far as I was concerned, they did that really well. And they set out with the objectives to start with, then the strategies they were going to introduce to achieve those objectives, and then action points that flowed from that, which is from a business, I'm a business person through and through, and that is exactly how you do it in good business practice. So I was delighted when that happened, and I was even more delighted when part of it was setting up an innovation ecosystem for the whole of Taranaki. Some regions throughout New Zealand have done it extremely well already, Bay of Plenty being one, but there are others. Manawatu is not too bad. And and then I was again delighted when, as part of that, Justine offered to appoint an investment advisor and invited me to be on the selection committee. And the long and short of it is we ended up with Stephanie, who's doing a great job. You've been in the job about a year now. Oh, you started right at the beginning of COVID. Yeah. And so that's my contact point from Launch Taranaki's perspective. But really, Stephanie is sitting over all those initiatives that are coming out of, well, certainly from an investment perspective, sitting across all those initiatives that are coming out of the strategic plan, Tapu Wairoa. So I'm doing the presentations on what investors are looking for. It does go into a lot of detail about everything that you need to run a business, because investors want to know that they want to know all the answers to all the questions associated with your business. So I will be covering a whole lot of things that are relevant from everyone's perspective, not just the investor. But Launch Taranaki doesn't provide all the support services for that. But Venture Taranaki is coordinating with the rest of the market to make sure that there is mentoring, which we don't provide. Well, we will provide some mentoring for companies we might invest in, but general mentoring, guidance, finding support activities, accessing government money through Callaghan Innovation, all those things, government grants, basically sit with Venture Taranaki. So it's great. It's great we're working closely together, but I just wanted you to be aware of that full picture. So if you come and talk to me afterwards, I don't have all the answers about everything. I'll probably shunt you on to Stephanie because she's got the ability to find the answers better than I have. By the way, Launch Taranaki has no paid staff. We have 2 of us, 24 members. 2 of us are technically retired, and we tend to do everything on a buck-she basis. So I love it, I enjoy it. It gets me out of bed in the morning, but I'm a limited resource, okay? Now, the format will be the same as for the first session, basically a half-hour presentation, and the second half-hour will be for questions from you. I may need to truncate that first half-hour presentation, but that'll be easy enough. So, what do investors want to know? Part 2. These are from last time. These are some of the slides we presented. So, are you an entrepreneur? If you tick all those boxes, all 7 boxes, you're a long way down the track. If you don't tick some of them, then it's possible to improve your skills. I mean, some of them self-motivated to be successful, that can change over time. And clearly understanding what you have to offer. I mean, if you think of a school leaver, they're not going to be able to tick all these boxes. They might think they can, but they really haven't lived long enough to actually be able to do it. But if they had 10 years experience in the world, and they really want to get ahead financially in life, then they're going to start ticking a whole lot more of these boxes. So, and the other thing is that a lot of the best companies I've seen have actually had 2 founders, not just 1 person, but 2. And there are a number of reasons why that works. You know, at least you've got someone to share the problems with. You can go on holiday and you've got someone else that's there, got skin in the game, worrying about it. And 2, you can have different personalities. So some may be great at one person might be great at networking. Another one might have basic money management skills. And between the 2 of you, once you get to 3, it gets more complicated. But I often think 2's better than 1. Although I've definitely seen 1 person be the driving force. Your planned type of business, basically I said traditional, which is like where you manufacture product. I mean, someone that I don't know is making yogurt and going to sell it through the supermarkets. I call that a traditional business. Or technology-based, they may have some new technology. Software as a service, which is like I used the example last time of Xero, which is an accounting platform on the web, and not-for-profit. There's no right answer with these, whatever. The only right answer is what you want to do. So if you've got a social networking thing and you don't necessarily want to make a profit out of it, you can turn it into a big business. I mean, look at Wikipedia. It doesn't run on a commercial basis, but it's massive. And they set out to basically be not-for-profit. So again, there's no right answer there, but you need to be clear in your own mind which category you're in. And you also need to be clear in your own mind about your intentions. Do you want to grow and sell, let's say within 10 years, and in the process make enough money for you to retire on? Or do you want to build and hold this? And last time I used the example of Juno Gin, where the founders of Juno Gin, husband and wife team, basically they do want to grow, no problem, but they want to do it at a pace that they can do it within their own resources. And the relevance of that is that you don't necessarily need to bring in other shareholders. and other funding. Because if you do it at a pace that you can manage yourself within the profits that you're making out of the business. So again, there's no right answer, but you do need to be clear, because investors like the angel group is really only interested in the top bullet point, because they're interested in an opportunity where they can invest. And if you're going to do it under the second bullet point, then where's the opportunity for the angels to invest? But that doesn't mean to say it's not good for venture Taranaki to get the economy of venture Taranaki growing. So again, no right answer, but work it out clearly in your own mind, because investors will ask it. I mean, it'd be one of the first questions, and if you approach me for funding through Launch Taranaki, I'd ask you which of those categories you're in. So there you are. Those were the three categories. So the coloured ones at the top are the three we covered last week. We've now got another 7 items to go through, which are largely financial related. Okay. I'll very quickly just go through these. Product and service, what problem does it solve? Product validation. By the way, the first bullet point, I think someone asked me last week what was the most important thing in this whole slide presentation. If you aren't solving a problem out there in the marketplace, then even if you're running a not-for-profit organisation, it's going to be heartbreaking if no one wants it because it doesn't solve a problem. People are too busy to actually do things for fun. They only want to use something that you're supplying to them if it solves the problem. Product validation, you've got to make sure your product works in the marketplace. Unique competitive advantage, IP searches, etc. Scalability, expected launch date, We'll cover some of these again in the financial. Market, what's the selling price for your product or service, and what's the market validation at that price? Because it might be the best mousetrap in the world, but if it costs 20 times more than what we've currently got, are people actually going to buy it? How large is the available market? What competition exists? What share of the market will be captured? What geographies? So you're just talking New Zealand, or you need Australia, or do you need all the English-speaking nations around the world? And what are the barriers to entry? All common sense stuff, really, but it's a useful checklist. And channels to market. As I said last week, a number of times I've seen people with a good product. It's obvious that people out there in the marketplace need it, but how are you going to connect the two? And for example, if you need to go through a supermarket chain, will the supermarket chain be prepared to stock your product? Because they're limited with shelf space, and so they only want products that they are confident will actually turn over and make money for them. Initial channels versus later channels. You may recall I said that when you first launch a product, you usually want to get some early adopters, and you usually want to work with people that are using your product, or distribution channels that are selling your product, that are going to give you feedback, direct feedback. So without that, you don't improve your product. But once you've actually got enough feedback and you think you're getting a product, what we call a product market fit, there's a fit there between what products provides and what the market's looking for, then you may change to a different channel. You're not desperately looking for day-to-day market feedback to improve your product. You're confident that your product will go the distance in its current form. You'll tweak it later on, but advertising, promotion, brand development. Need to do all those. So we now get to the new slides. People. And you might think that people isn't financial. I assure you that the major cost in your business when you start it up will invariably be people. That's your staff. So who are the key people? And you're obviously going to be one of them if you're the founder. And if you've got another founder alongside you, that founder will be a key person, or should be a key person. If they aren't a key person, then don't take them on as a founder, would be my advice. So if you go right back to that entrepreneurial thing, they've got to share with you those values. And between the two of you, you actually have to cover all those bullet points. I won't drill down on this, but there are some people that think husband and wife teams are not a good idea. I don't subscribe to that. I think it's horses for courses, and I think that some couples can work really well together, and others don't. From an investor perspective, investors always get a little bit nervous about them, but again, personally, I don't see why they should have to worry too much about it. So now there may be other people in your business that are key as well. You just have to think it through. Who's key is a person that if you lost them, that could cause the failure of the business. So they may be a key software writer if you've got a SaaS business that you're developing. Maybe a key salesperson that's got all the contacts that you need. What shareholding do these people have? Because if they haven't got a shareholding, then there's a risk they are not going to stay, you're not going to retain them. Because the reality is with startup companies, you can't afford to pay people what are commonly recognised as market rates. Market rates is if you went to Price Waterhouse and said, what's the market rate for employing a software writer, code writer, they would give you a figure. And it would be in the hundreds of thousands probably. And it would be over 100,000 per annum. You can't afford to pay that initially. So having people, key people on shareholdings is one way to go. And then you pay them less salary. What skills and experience do they have? Again, these are the questions that you'll have the answers to, but the investor wants to know. What's a track record of commercial execution? So you may have people that are good technically, they may be passionate, they may tick all the boxes at the beginning for an entrepreneur, but and if you haven't got a track record of commercial execution, what I mean by commercial execution, has somebody in the team run a business successfully in the past? And because converting a bright idea to a commercially successful proposition is a challenge. So investors want to know that. What skills shortages exist? And it's quite likely there will be skills shortages initially. But if you can tap into them, and that again is where Venture Taranaki can help, they may be able to find somebody locally in their network that can actually help you through. And they may be prepared to do that as a mentor on a no-charge basis, particularly initially. What's the remuneration method? Again, you can have share options. Again, you will not probably be able to pay market rates for people, particularly initially. So somehow you have to work out a way to remunerate people. And what is the corporate or governance structure? By that I mean the corporate structure is within your business, and the governance structure is really your board of directors. Now, you don't need a whole lot of directors. Maybe one external director, and if there are two founders, you have a board of three, the two founders, and one external person. But it's good to have an external person with some experience in being a director. Because the biggest thing that directors do is that they will challenge you over the risks that you're taking. And as a founder, you can't afford, I think I said this last week, you can't afford to get out of the bed in the morning worrying about the risks or thinking about the risks. You've got to think about the opportunities. But if you have got a board where there's at least one external person who can come along and think and challenge you and think about the downside risks of some of the things. And then you have a debate. Doesn't mean to say that that person dictates what you do, but it does mean that at least you've got somebody in the team thinking about the risks that you're taking. And do you have professional advisors? I mean, you haven't got money to spend on lawyers early on, but sometimes you need to spend a few dollars on them to get the right structure for your business to start with. I mean, for example, if you're coming along to an investor, the investor will want to know that if you've got some patents or IP, what we call IP, which is intellectual property, which covers design marks, patents, and like ownership of technology. Investors want to know that that is held by the company, not by you individually, so that if you get sick of it down the track, you can walk off with your IP and use it, set up another company, and the investors are left sitting with nothing. So you need to get the right structure at the beginning. So that's people. Now, the business model. The business model is about the net flow of money out of other people's pockets into yours. Now, the word pockets is probably old-fashioned, because I'm a bit old-fashioned. It's now about bank accounts, because you don't actually hand cash over. But what it means is that somebody is actually prepared to spend money and it ends up in your pocket. I have seen ideas where people spend the money and it ends up in somebody else's pocket, and the person that started the business actually thinks that they're actually doing something great, but they actually haven't got a commercial model, because the money doesn't end up in their pocket, it ends up in somebody else's. So you need to understand how that happens. And I mean, just to take a simple example, if you came up, let me take the yogurt example. You make cans of yogurt. You go and sell them through a supermarket chain. The supermarket chain charges you they want a markup. And by the time they've taken their markup, you don't even cover the costs of manufacturing the product. You can't put your price up, because the supermarket won't be interested in selling it at a price that's too high, because they're not going to get the turnover. And if you do put your price up, you'll sell fewer products. And then you don't get the volume through your plant that you need to actually generate. So you end up with money in your pocket, but it's not enough to actually cover what's going out of your pocket in costs. So that's what I'm talking about with a business model. And sometimes it's called a commercial model, but you need to work it out. It's not difficult. You can. I'll cover it in cash flow in a minute. Is the model profitable? Is it scalable? So you may not make money initially, and it's quite common for companies not to make money for the first year or two. But somewhere down the track, you've got to get enough volume going through, enough cans of or containers of yogurt being sold, and if you can only make, like, I don't know, 1,000 of these per month, and to make $1, you've actually got to be producing 5,000. You've got to work out how you're going to scale up to be able to do that. And is it sustainable? Because, I don't know, various things. I don't know, you might be making sausages, and it's got a whole lot of flavours and things in there, and it's all been very successful in the past. But going forward, the market is turning against processed meats, or meats full stop, I don't know. I'll just take that as an example. Or if it's software, the average life of software is about 10 years. So you've actually got to launch your product, get it well established in the market in the first 3 years, and then make heaps of money out of it in the next 5 to 7 years before you've got to rewrite all your software. And you might decide that that's too difficult because it's been displaced by some new technology. I mean, desktops, I've seen mentioned last time payroll systems which were designed for use on desktops. Well and good, Well, those products last about 10 years. And then iPhones came along. And everyone people running small to medium-sized businesses want to be able to do the payroll on the iPhone. So you had to reconfigure your product totally. And sometimes other people come through and do that ahead of you, or sometimes you haven't got the cash, or sometimes you haven't got the will to actually do it for another 10 years. So you've actually got to have a business model that actually works in that period that you've got. Now, cash flow, fundamental. Cash flow is very simple. You write down the projections of cash in month by month. Then you write down the projections of cash out month by month. And just because you sold a whole lot of product 1 month doesn't mean to say you get the cash in that month. I mean, again, selling your yogurt through the supermarkets often won't pay you for 3 months. And if you say, well, you go along and negotiate with them and say, look, I'm going to go broke if you don't actually pay, but they'll say, well, okay, well, we'll pay you monthly, but we want a 5% discount for us. You're not allowed to put your price up. We just want a 5% discount. Well, 5% over a 3-month period, if you work it out, per annum is about 20%. And that's a lot higher than, the interest rates that the banks are charging at the moment. So that's the effective interest rate that the supermarket will charge you if you actually want to get paid early. So you've got to work out cash in, not on the basis of when you actually do your sales, but when you actually receive the cash in your bank account. And again, you've got to be careful because some people, in your supply contracts, you have to pay your suppliers before the end of the month. Or maybe on the 20th of the month you've got to pay them. And then suddenly you'll find the supermarket doesn't pay you till the 3rd of the next month. And so you go through the end of that month not balancing your books. These are all the issues you need to get your head around. I mean, I know a number of people in the room already will understand this, but there are a lot of people don't. So the net difference between those two, cash in and cash out, is what we call the burn rate, which means from an investor's perspective, that is the rate at which you are burning cash. It might be not uncommon for startup companies who've got good potential and being well managed to be burning $20,000 or $30,000 a month, and which is $250,000 to $300,000 per annum, and it has to be funded. So the good news, you'll achieve cash break even when your burn rate is 0. In other words, the cash coming in is enough to cover the cash going out, even though you're growing. Because when you're growing, there'll be more cash going out every month. And I can't overestimate this final statement. Running out of cash is the major cause of business failure, okay? And investors know that. So investors will be absolutely focused on your cash flow. This is probably the next most important thing after solving a problem, is not running out of cash or managing your cash flow. Okay, now I'm going to put these ones up all together because when you're looking for funding, these are kind of the steps, and you will see the seed funding, which is, for example, coming from family and friends, but there also are increasingly ways to access government money or money from other organisations like TSB Community Trust they have conditions on it, but they do kind of seed funding. And that is really to get you going. It's called seed for a good reason. Get you going. Usually the amount of money you can raise through that is probably in the range of $10,000 to $100,000. Secondly, angel funding or crowdfunding, and there is a difference between the two. I'll come back to that in a minute. But the amount of money you can normally raise through that, if your idea stacks up is $50,000 to $1 million. Venture capital firms, there aren't many in New Zealand, to be perfectly honest. There are quite a few in Australia, and there are a lot in the USA. They will come in after the angel and crowdfunding stage, and they will take a decent slice of your business and pick you up and take you to another level. You really only want to go there if you are running a high growth business. Lifestyle, they wouldn't be interested in lifestyle businesses. And then after that, by the time you're looking to raise 2 million to 30 million, private equity funds are out there as well. There are private equity funds in New Zealand. I used to manage one in Wellington. So you will notice that those dollar amounts overlap, which is useful. And I'll come back to this angel, the second bullet point, the angel funding versus the crowdfunding. You may have heard of crowdfunding. There are various organisations in New Zealand, and some of them cross between Australia and New Zealand, like Pledge Me, Equitise, Snowball, and a good example here is the sushi train down in the city centre. The sushi chain wanted to set up, and they wanted $350,000, and they went to, I forget who it was, I think it might have been Pledge Me, and raised $350,000. They ended up with a whole lot of shareholders. When I say a whole lot, I think like 250 shareholders. And they had a deal with those shareholders. Anyone that invested got vouchers on a regular basis so that they could go and get a discount at the sushi train. So from the sushi chain's perspective, it actually worked for them because they really only wanted $1 of money. That was to buy the sushi train and set up their premises. But they didn't need any ongoing money after that. So it was a one-off capital raising. Two, they needed the full amount, basically, of $350,000. Four, they actually wanted a whole lot of people like all of us going along there on a regular basis and using it. And the way they did that was by handing out the vouchers. And they wanted us to take our friends along, or us to go to dinner parties and talk about this fantastic sushi train, etc., promoting it. So there was a lot of sense in that. But if you're starting a business that needs ongoing further capital raise, like I mentioned Automio last time. Automio is Claudia King, and they are automating the production of, they've got software, so it's a SaaS company, and they're automating the production of legal documents for lawyers. I mean, they've done 4 or 5 capital raises so far, and each time they go back to the existing shareholders and ask for some more money, and then they bring in a few other new shareholders. Crowdfunding would not have worked in that situation, but angel groups are actually quite good on that sort of thing. So there you are. I mean, if you're starting up your businesses, you're going to be in one of the top 2 categories initially. I just put the other categories in so that you can see there's a chain to go through when you get bigger and bigger. Final comment on all this, debt is not good. Debt's not good for 2 reasons. One is, whoever gives you the debt will expect to get paid interest on it. And they will probably, if it's a bank, they want to be paid interest on a monthly basis. And that's another drag on your cash flow that you don't need, particularly before you reach cash flow break even. 2 is that whoever lends you the debt can end up doing well while you do badly. They are not pulling in the same direction as you. I mean, I was involved in a company in Auckland that had borrowed money at 8.5%, not from a bank, but from the shareholders who took convertible notes. And convertible notes are a debt, basically. But you can, whoever's holding convertible notes can convert them to equity later on. But for the time being, they're debt. And the interest on the debt was 8.5%. This is going back about 5 years, so 8.5% was par for the course in those days, particularly for risky debt. But if the company fell into default because it couldn't pay the interest on a monthly basis, then the interest rate doubled to 17%. And suddenly interest is accruing, don't have to pay it on a monthly basis, but it's accruing at 17%. And it doesn't take long at that rate for basically all your equity in your business to be chewed up. So the shareholders end up with no value, including you as the founder. So this is my point, is that whoever provides you with the debt can actually do very nicely out of it, unless you go completely broke and there's no money to even pay them back their debt. But most situations I've seen, there has ended up being enough money to pay out the debt holders, but nothing for the shareholders. And you're working for them. So it's much better to have equity, and because at least those people that have provided you with equity are in the same boat as you. They've got the same interests as you, and they like to work with you to try and help you through the crisis. Risk management and compliance. I've been a director for 35 years probably of various companies and various roles. And I've worked out that directors have a few key responsibilities. One of them is to make sure that the right person is leading the company, and the right people are in the key roles. Two is to make sure that there's a budget and a financial plan, and you review against that on a regular basis, and that there is funding for it. Three is ethical issues, that you're actually not breaking the law. And four is risk management and compliance. And risk management and compliance is probably what most boards of directors spend 2/3 of their time discussing, to make sure that, as I said before, the founder can't afford to spend too much time dwelling on that, because they will not be running the company and they will lose enthusiasm for doing so. But if you have got independent people on your board, they can and should actually spend a lot of time looking at your risks and your compliance. So here are the categories, and I won't spend much time on these, but product service risk. So, is your product robust? Or is it going to get displaced by something else? Are your competitors going to react badly to this? I mean, you might be able to launch your product in competition with somebody else, but then the other party, who's already been there in the marketplace for 5 years and is well established, suddenly cuts their prices to compete with you. And all your financial projections go out the window. Risk. Channel risk is you might have a distributor, and if the distributor goes broke, you not only lose your distributor, but you can lose all the money that you had tied up with the distributor, money that the distributor had collected. Political, economic risk, financial risk, well, that's mostly running out of cash or interest rates going up. You borrow heaps, like I said you shouldn't, and suddenly the interest rate doubles. And execution risk, that really comes down to you and the team and your ability to actually carry out your plan. Your directors can help with this, and I probably should have put the S on the end of directors in brackets, because you may only have one, as I mentioned before, but your external director can help with this. I'm a director of half a dozen different companies, most of which are early, small companies, and that's what I spend most of my time doing. The investor's return, the likely return on investment for the investors. So if investors put in, let's say, $100,000, they are going to want a return on it. And they want to know from you what return they're going to get and how. And I said, note that startup companies are high risk and therefore external investors expect high returns, at least 20% per annum. They don't need it per annum, they need it like after 5 years, it'll be, well, make it easy, after 4 years at 20% it kind of doubles. So they will want twice their money back after 3 to 4 years. And if they're going to have to wait 7 to 8 years, then they'll want 4 times their money. But so should you, at least. And often you aren't actually putting money in, you're putting time, it's what we call sweat equity, you're actually putting your own time in there. And, but you know, you need to value that. And you should be getting these sort of returns on your time that you put in as well. Now, if you are building not a lifestyle business, but that grow and exit business, investors will want to know these questions. Who are going to be the likely buyers? What's the valuation likely to be on exit? And what's the likely timing of the exit? Well, when I say investors want to know that, you should be ready to answer that question, because there are 2 types of investor. The first type will want to know all that detail. The second type will say, and I tend to be in the second category, as long as we're adding value and building value and growing the business, and ticking all those other boxes that we've covered, the exit strategy will emerge. You'll have options. And one option is not to exit, it's to carry on growing it. Maybe you as the founder doesn't want to continue managing it, but that's okay. Once you get to a certain size, you can afford to bring in what I call professional management, pay the market rates, and that might happen after 7 to 10 years. I mean, my son is doing that exactly, that thing. He's got an office cleaning business in Wellington. And they've grown it from about tenfold, from $500,000 turnover to about more than tenfold actually. And my son is now thinking about, well, it generates good cash flow. I don't necessarily want to lose the cash flow. If I sell the business, it's only a cleaning business and it may not get a high valuation, so I'm better to hold on to it. But I don't want to keep doing this day in, day out. So he's thinking now about getting or having an exit strategy for himself rather than an exit strategy for the company. But again, there are 2 of them in that business and they don't have any other shareholders. So that's more in the lifestyle category than the grow and sell. So there you are. Hopefully all this is successful for you. And now, questions?
So if you need a director, like, I mean, if you don't know anything about anything, how do you access directors? How do you get one?
If you don't know anything about?
Like, how to reach them? How do you access directors? To help you out in your business, to be your director.
Oh, directors. Okay, how to get directors. Well, you're better to start with mentors, I would say, but Stephanie's in the deep end of this, but I think you're probably better to start with mentors. I mean, I'm prepared to be a director of a company. If I do, I want to invest in it myself, so it has to tick all these boxes really well. Otherwise, I'm not prepared to be a director of it. But even if I am, I will want to work with that company for a period as a kind of a mentor to start with. And I'm doing that with one in particular here in town at the moment. And I'll work with them as a mentor to get them to the point where they can tick a whole lot of the boxes. And when they do, I'm then prepared to invest cash into it and be a director. But that's me. There will be other people who are prepared to perhaps be a mentor or I didn't talk about advisory boards, but that's another one. They're not actually technically directors, but they'll act as advisors to you. And again, Venture Taranaki is building a list of people that are prepared to provide these services, you know?
Yeah, so we have definitely that mentor service. That's, like Ben said, a good way to start. But to answer your question, there's also the Institute of Directors that have a database of directors if you would like to go sort of that route of putting an ad out specifically to reach out to someone to as a director of your company.
You may be prepared to, you may have a family friend or I mean, I'm a director. I fulfil that role with my son's business in Wellington. So there's two founders there and they asked me to be a director. And well, I told them everything that I've just told you, and they said, well, we need a director. Would you be prepared to be it? And I said, yes, I'm prepared to do that. But because I didn't invest in the business because that's family. But what I've found, I mean, people like myself find that if you don't actually somehow have some benefit in there yourself or charge something yourself, then your time doesn't get valued. And that's why I respond the way I respond. But that doesn't mean to say there aren't other people. I mean, a number of the mentors of Venture Taranaki will be linked into are people that are running their own businesses or whatever, and they're prepared to give back a little bit for nothing on the side to help people get up and get going. But whether they actually put their name on the sheet of paper as a director, because you can be personally liable. I mean, the biggest risk for a director is the company runs out of money and someone sues the directors for negligence. And you've got to be really careful as a director. So there are ways, but again, I would suggest you work through with Stephanie to get some further suggestions.
Question on investors. If you're being approached and let's say you're early stage by potential investors who are more interested in your 3 to 4 year forecast than the actual risk and burn rate, is that investors you should run away from?
Oh yeah, I mean, I haven't talked about quality of investors. Again, the more of these boxes you can tick and the better presentation you can do, the better quality of investor. Now, what's a good quality investor? Good quality investor is somebody who will help, not just put money in there, but will actually help you be successful. They will do all that risk management, compliance stuff for you. I mean, what I do is I actually help people build their financial models. So I provide a lot of that, a lot of the substance that's necessary to go and help them raise money. I also sit in on the presentations with them when they're going to raise money from other parties. So, you know, that's what I'd call a good quality investor. The other thing is that they will be prepared to follow on. Like you get down the track and you need some more money, they will be prepared to provide some more money. Not all the money that you need, but they will. So, yeah, a good quality investor is someone that's going to help you succeed.
And I would follow on to that and say that there is investment available for the right businesses. So don't feel like you have to just get whatever sort of is available to you. If you work on sort of your business model and your proposition, then the quality of an investor has in.
Well, I go to the question because I have started. We are within Soda Inc. in Hamilton. It's part of Wintech. And when you pitch there, you get like a group of 12 to 15 people around you. And there are always, you get a lot of very interesting questions, and then suddenly someone starts talking about the forecast in 3-4 years' time. And I think like, maybe, yeah, that's why the question.
And the forecast comes to the return.
Yeah.
That's the link to the forecast.
I have a saying that I've used time and time again in management, because I was like a chief executive for not just a director, but a chief executive for 35, 40 years. And the saying is, there's always money for good ideas. But you've not only got to have a good idea, you've got to present the good idea properly. You've got to prove that it's a good idea to people who haven't put their money in. Because from an investor's perspective, you get one opportunity to make a decision about this. Once you put your money in, it's sunk. You've got to stay with it and help it succeed, otherwise you're never going to get your money back. So you get one opportunity, that's at the beginning. That's why it's so important to actually get your thinking clear about this to start with. And the better your presentation, the better quality of investor you're going to get on board.
So Helen will be our last question, but then we will stick around afterwards, so any other questions, please do feel free to come up to Paul.
Just with projections, when you're so new to the market and you just got yourself out there and just starting to get that feedback, how do you make accurate projections?
Well,
based on what information that you
what sort of a product?
So I'm considering like my own startup, for instance, and one of the things that we don't fully understand yet is how much it's going to actually cost us to acquire a client. You know, and it could be $150, it could be $250,
yeah.
And that's quite a big difference, you know, to be able to make projections on. So we need to actually get this piece out to the market to start getting the feedback to then be able to make those projections. So do you see a lot of people just pulling projections out of their ass? Or,
so the product or
essentially?
The product or services? Don't tell me.
Service.
It's a service.
It's a service.
Okay.
It's a product that provides a service.
Okay. Well, sometimes, I mean, if you're manufacturing a product, you can...
It's not a manufactured product.
No, but if you are, you can actually price that per product. You know, you work out how, and more volume you do, invariably, the cheaper the production cost. Because often people outsource it. But if you're providing a service, then your cost of sales are going to be basically fixed costs. They're going to be people's salaries, basically. And there may be some advertising and promotion. You know, there may be costs if you're going to use Facebook and social media to actually promote. There will be costs associated with that. But you can work those out, and then you've got to spread that over the sales that you achieve. So those tend to be like fixed costs per month, rather than related to per sale or per item, as it would be in manufacturing. So yeah, when you do your costs, you list out all the names of the people that you're going to have working for you in sales. And it'll be, you know, it might be $5,000 per month. And you get $15,000 for that. And how many are you going to sell? So, and you have to spread those costs over what you're selling.
So you just assume that you're going to sell that amount to cover those
You do.
costs? Okay, that answers the question.
And that's why investors will want to know what the burn rate is, because basically, they'll say, well, if you don't achieve any sales, the burn rate is $15,000 per month. And you're going to need $180,000 for the next 12 months. And you're only asking for $90,000. They're going to say, that's only going to last you. That's called the runway. The runway is only six months. And we all know that before you run out of money, you've got to actually start raising. And it always takes about 3 months to raise capital at best. So if I'm putting my money into that company and putting 90,000 in, we've almost immediately got to start raising some more from somewhere else. These are the things that investors understand, and you need to understand them so you're prepared for the question.
Awesome. Okay, I'm sorry because we are out of time, but we will catch up after the session. So thank you so much, Ian. Very informative session. Again, and love the interaction, so we will stick around to answer some of the questions for you. So if everyone could just give Ian a round of applause.
Thank you.